Hey everyone, welcome to the show. My name is Sam Shaw and I'm the founder of Wall Street Mastermind. This is Wall Street Mastermind's Elevate program, where we take our flagship coaching program and give it away for free to high potential students who are currently in a difficult financial situation. The goal of this show is to first and foremost give these students the coaching and guidance that they wouldn't be able to get otherwise and help them break into investment banking. Of course, we also want to give all of you an in-depth look at how to go about your own investment banking preparation process the right way, so that you can model it after the same proven methodology and strategies that we've used to place over 90% of our students into investment banking across every single bulge bracket and elite boutique bank over the last several years. With hundreds of thousands of applicants competing to break into investment banking globally each year, our team only has the bandwidth to help a very small percentage of you. So my hope is that this show helps all of you, even if you aren't able to directly participate in our program and work with us. So let's get to it. In this session, we do a mock interview with Ximena to prepare for her upcoming first round interview with Morgan Stanley. We talk about her why investment banking answer, went over how to answer market related questions, and practice some slightly more advanced technical questions on the accretion, dilution, and LBO side. Hey Ximena.
Hi Sam.
How's it going?
Good, how are you?
I'm good. What's going on? What's new?
Good. It's been a crazy week, midterms and everything coming, but it's all good.
Okay. So you're done with midterms now or still going through it?
No, they're still going through it.
All right. Well, good luck with that.
Thank you.
Let's see. Any new developments since we last talked?
More conversations, just moving that forward. I've reached out to basically all the people I had initially meant to reach out to. I got another referral to talk to somebody else from a good the conversation I thought hadn't gone too well a while ago. So he was like, no, that's great. And then got another referral. So I'll talk to somebody else.
Oh, and you reached back out to the guy that you thought you messed up with and he said it was fine?
Yeah.
Okay. Yeah. That's good.
He was like, hope you're doing good. Why don't you talk to this person? So that was fun. Yeah, it's definitely been a learning process. So yeah, I did that. I met with I've had some mentoring from the person that really helped me at JP. So I met with her this morning and she was kind of helping me talking about like the past interview, what I could improve on, what I can improve on. And so that's been really helpful.
Did she find out some feedback for you?
No, she didn't, but she told me to email them again. And she gave me another contact of kind of the person in charge of the program. And she said I could ask her to give me some feedback. So that was what she said, to just be persistent. And she was like, no, you should get a response. What she told me was like, you should ask for the feedback, like you prepared for it. And I don't know, you should be more confident in asking why you didn't get the offer. So that helped a little bit to boost that. I kind of went on an small emailing spree after that, just more confident in kind of asking. And then, yeah, so it's been that. Then Citi mock interviews this week. And from that, we should be having the interviews, I think it's the 14th. So in about a week. And yeah, and then Morgan Stanley is tomorrow. That's the first round.
Does the Citi mock interview determine if you get an official interview? Is that what it is? Or
basically, that's kind of what they said, but I'm pretty, yeah, basically. It's like our mentor technically is the one that pipelines us and lets them know. That's what they said, if we're able to get a mock interview, an interview or not.
Okay. All right. So he basically will just decide if you should get a real interview or not after he gives you a mock.
That's what they made it seem, yeah.
Okay. But I guess the more immediate, that's good. I guess the more immediate thing is this MS interview tomorrow, right?
Yeah.
Okay. How are you feeling for that? Are you feeling ready, or do you have any questions or things that you aren't sure about before you go into the interview?
Maybe just the one thing about my why MS question, what I go through is I go basically their leadership stands as a bank, and then I go their people, and then I talk about kind of what they said at the early insight session. And then I go into they have a core value that they kept emphasizing in the program. They always say, like, we're really big on giving back. Like, we have the Morgan Stanley Foundation and all of this. So I didn't know if you would recommend that as being something like that's one of the reasons why I would also want to go. Like, that's a core value that you guys emphasize, or is that weak?
I don't typically go in that direction, but I don't know. It depends on how you do it, I guess, if you wanted to do that. Like if there is some way for you to, well, I guess actually there might be a way for you to do it, like, because you can tie it back to your volunteering in Kenya story and talk about how that's always been like a really big part of who you are. I just think that most people, when they say like, oh, I want to work for a firm that like really gives back or whatever, like it comes off as kind of disingenuous, or it's just like you're just saying that, right? But it's like, come on, that's not really the reason why you want to work here. But I think if you can actually like back it up, tie it back to something personal, then I think it can come. It could work. So yeah, like if you were to do that, then that's probably how I would do it. Because you can't just say like, oh yeah, I really want to work for Morgan Stanley because like you guys are all about giving back. And it's like, it's just not that believable, But it depends on like what your other, I don't know, depending on like what other reasons you have, right? Like you can only give them so many reasons. So there's an opportunity cost. Like you got to pick your best ones.
Okay. Yeah.
So
yeah.
So what are you thinking about going with them?
Well, yeah, so that was kind of my thing. And I was going to tie it back personally to me about like always like wanting to give back to community, like always being a part of volunteering growing up, and then going to Kenya. That was my thing, where I was like, that's something I'm dedicated in. And then like giving examples of what they've done. That was what I was going with. But I could also just mention people I've talked to at MS, because I could say like their diversity and then people I've actually talked to. I was kind of tying previously like diversity and people together.
Okay, so you had 3 reasons, or just to recap, 3 reasons or what? And go in order that you would.
So it was their leadership position as a bank. Originally, it was, like they're constantly on the league tables. They're generating some of the highest deal fees in M&A, debt and equity. So it'd be like a very good, well-rounded experience and a lot of exposure to big companies. And then it was the people, and then to tie that back to like the insights program and diversity. And then the final one was like, well, one of you guys' biggest core values was giving back. And this is something I think is really great with everything you guys have done with Morgan Stanley's foundation. And personally, I had this experience, and I thought that was really significant from the firm that I thought I really connected with.
Okay, so the second point, the people and the diversity thing, is one thing, basically.
That's what I had thought of doing.
Okay. All right. Yeah, I think that's fine. I think that can work. Morgan Stanley consistently, at or near the top of the league tables, not even just in one area, but across the board, right? Which means, better deal experience for me and better, learning opportunity, right? And so that's obviously very important. But there are a lot of great things out there. And so I think what really sets Morgan Stanley apart from, some of the other top banks is, first and foremost, definitely the people. I've met X, Y, and Z person during this, I guess you're part of the diversity program, right? Like during this diversity program, and had whatever great positive interactions with them, and just touch on that, talk them up a little bit, and then last but not least, I noticed during the info session that you guys put a lot of emphasis on giving back to the community, and you talked about the Morgan Stanley Foundation and XYZ things that you guys are doing. And I might even say like, and I know like maybe a lot of people would say this, but for me, like truly, like being able to give back has always been like very important to me. It's why I did blah things in the past, right? And so I want to work for a company that's not just, not only like very successful, and not only a company that's going to like, give me a great experience, but also I think I would get a lot of fulfillment out of working for a company that's making a positive impact at the same time. Something like that.
Yeah. Okay. Yeah. Okay. Okay. I wanted to confirm that. I think overall the same. I saw they seem to ask a lot like why IB, why not sales and trading? So I'm guessing for that, I was thinking of like, well, they're both, even though they're both like you're an intermediary in both and you're advising. I like the fact that you're advising companies rather than like security. You're not advising on trading and selling securities, but you're advising companies directly in the strategy behind how companies merge or how companies raise capital is what really interests me. And that's why it's more investment banking, because of that like corporate company.
Why IB and why not sales and trading, you said?
Right. Yeah.
Okay. I mean, is there anything on your resume that will indicate you want to do sales and trading, or why do you think they're going to ask you why not sales and trading?
No, I was just going through kind of the Excel sheet of the typical questions that they ask. And 2 of the phone interviews asked that. So I didn't know if that was just, they would ask that to see like kind of your knowledge of what investment banking is.
I see. Okay. So your answer to that was what you want to.
So I'm guessing the difference is the fact that you're advising companies. Like you're an intermediary in both, but the difference is you're advising companies and you're not in the middle of trading and selling securities. So they're kind of completely different in that sense. So it was like the part that interests me the most is being at the strategy of how companies are interacting and how companies are trying to raise capital and the most strategic way to allocate their capital.
Yeah, I think I would say like, yeah, I mean, there's no right or wrong here. It's purely a personal preference thing. But for me, I would much prefer to be an advisor to these companies and help them create value, right? Like what you're doing as an advisor is if you make the right recommendations to these companies, then their value of the businesses should go up, right? So you're helping them create value versus like in sales and trading, I would say you're not really like creating value. You're like trading and trying to like make money from the value that other people have already created, right? So it's kind of like 2 different things, right? So yeah, I would make that distinction. Just like I want to actually like, be in the trenches, working with these companies, advising them, and helping them create value, which I don't think is something that you necessarily do in sales and trading. And there's nothing wrong with that, but just what I would like to be able to do with my job. And I just find that to be more strategic, find it to be the work to be more interesting, and I find the impact to be more fulfilling, right? Something along those lines.
Yeah. Okay. That for they seem to ask a lot. I think what they seem to want to know is that you're like outdated with the news and trends. So I've just been going kind of crazy on that. I generally have been. But
you said recent.
There's 2 like I think they tend to ask like, where do you think that's what I saw on the Excel sheet. Like where do you think the S&P will be at in a year? Or like what is your sentiment? Or what is a current trend that's happening? So in the past,
questions that other people in Wall Street Mastermind got with Morgan Stanley. Got it.
Yeah, but in the past, no, because no one's interviewed for this one yet. I think this was an earlier program. I wasn't sure if anyone had, but nobody answered. So I think this is one of the first interviews.
Yeah. Yeah. So what's your answer? What's the answer for that? In terms of like where you think the market's going?
Well, so for general market trends, what I've been using in the past was like inflation and like semiconductor chip shortage, but I don't know. I've used it so much. I don't know if it's cliche. Maybe it's just me. Is it just, I don't know, is it too broad to talk about that? I feel like everyone knows that inflation is happening and like supply chain crisis.
Um, I mean, everyone knows it's happening, but I think it's like how you talk about it. You
Okay.
know, it's like if you go back to our framework, it's not the what that like makes or breaks the question, right? Like the what is yes, inflation is going up like crazy, but it's like if you can talk about why it's been happening and also like your opinion about where things are going to go, that's like kind of where you differentiate your answer from someone else who's also talking about inflation, right?
Okay.
Um, so I don't know, it depends on like what you're saying, but initially, like the reason why inflation was happening was, I think, you know, what was it like COVID and supply chain shortages and driving the cost of goods up and stuff like that, right?
Mm-hmm.
But now more recently, I think there's like also other factors at play now, right? For example, um, oil prices have been skyrocketing. And I don't know, it was over $130 at one point. I don't know what it was today. And the reason why that's happening is because of the war between Russia and Ukraine. Right? And so Russia controls a lot of the oil in the world, and the rest of the world is, I mean, the US and Europe are talking about, um, sanctioning, or they've already been sanctioning Russia, but like so far, at least up until a day or two ago, they hadn't like gone for the thing that's going to hurt Russia the most, which is like stop buying oil from them, right? Because like by buying oil from them, you're basically financing the war for them, right?
Mm-hmm. Yeah.
But the reason why people haven't stopped buying oil from them is because not so much the U.S. because I think U.S. doesn't really doesn't really import that much oil from Russia. They do a little bit, but I think the U.S. has like other and U.S. has like their own oil reserves and stuff, so they're not as dependent. But like Europe is like very reliant on Russia for oil, and
Mm-hmm.
so, like so that's like kind of what's held them up at this point. But like now that they are like, I think Biden said today that the U.S. will stop importing oil from Russia, right?
Yep.
So that's going to cause, oil prices go up. You try to go fill up your car with gas, like all the gas prices have already gone up. That's
Mm-hmm.
going to mean that people have less money to spend. And that is what inflation is, right?
Yep.
And so a lot of people are worried that it could cause a recession, right? Which like, I think I saw a chart like every single time that oil prices have, I think, gone up by 50%, or is it 50% or 100%? I don't remember. Every single time that has happened, we've had a recession.
Okay.
And then so this time, like, or I think it's like 100%. Every single time oil prices have gone up by 100%, we've had a recession. And recently, I think oil prices just went up by 100%. And so, like, that begs the question, like, are we going to go into a recession? Right?
Mm-hmm.
You combine that with the Fed raising rates, like we're kind of like in a tough spot, right? Because the Fed can't not raise rates. But
Yep.
if they raise interest rates, then there's going to be less money out there, right? And less borrowing, which typically means it's going to slow down the economy. So there's just a
Mm-hmm.
lot of different factors going on. So like anyway, I'm like rambling a little bit, but like my point is, there's a lot of things you can talk about when it comes to inflation,
Yeah.
and it depends on like how you do it, and you can demonstrate that hey, you actually have like a really good understanding of how all the different pieces kind of like fit together, right? Like the causal effects of like when this happens and this happens and this happens and this happens, right? Most people, I think they can't go like more than one or two steps, right? So then
Mm-hmm.
like the answer is not that interesting, right?
Okay.
Does that make
Yeah.
sense?
Yeah. Makes sense. Yeah.
Okay.
Okay.
So a lot of this stuff is like, I mean, it's very well covered um, it's very well covered in all the news articles and stuff. So
Yeah.
just like read
Yeah.
up and get your talking points from there.
Yeah. Okay. Yeah. Um, okay. I had also just a couple technical questions as well. I was going through the just kind of plugging in numbers. What would happen? I wasn't able to get a good response. Um, if beta is negative for a stock, so you have levered beta that's negative for a stock. I didn't understand how if that went into CAPM, what a negative CAPM would mean.
If you had negative data for a stock, what would that mean for CAPM?
Like if it got to CAPM being negative.
Well, so I think if you have negative beta, have we seen negative beta in CAPM? Let me think about this. So we're not taking I don't think in CAPM we're taking like the absolute value, right?
That's what I was gonna ask y'all. That's what I was gonna ask y'all. I wasn't.
So if you're doing CAPM, then your cost of equity is beta times the market risk premium. So that means that your cost of equity will be negative. I think that like the only way you will have a negative beta in reality is like if you actually trade in opposite directions against the market, right? So for example, like when the stock market is going up, typically like gold is going down and vice versa. Like when the stock market is crashing, everybody's like flight to safety, going to gold, and the gold prices are going up. Right? That's when you have a negative beta. And so like for most stocks out there, like actual companies, but gold's a commodity, but like for most companies, like you're usually not going to have a negative beta. Now for CAPM, so I think the reason why I've never really seen negative beta when doing CAPM is because like when you're calculating the beta for your CAPM, you're taking like the average beta from your trading comps, right? And so you're taking like the average beta from basically your comps, and like typically all of your comps are going to have positive beta. So like,
but if they're all in the same industry, wouldn't they all have negative betas?
if they're all in the same industry, so what kind of company? But I'm saying though, like any company.
Okay.
I was trying to think out what kind of companies would have negative beta. Let's see what it comes up with. Yeah, so gold is the most widely used example, but gold is not a company, right? Because gold has an inverse relationship. What else? Industries that have negative betas demonstrate counter-cyclical movements with the market as a whole and basic level. Okay, so bankruptcy advisory services, sure. Career colleges / trade schools, because when unemployment is high, people without jobs go back to school. It's not a lot of really good examples. Someone else said gold is pretty much all I could find. Yeah, I mean.
Okay. So
I don't think you're really gonna run into a lot of companies out there that have, or like industries as a whole that has like, entirely, like where everyone has negative beta. I don't know.
Okay.
It's an interesting question though, but let's see, CAPM, if the firm had negative beta, that would make its cost of equity lower than its cost of debt. Yeah, so that's interesting. This person said, I had a super day at a bulge bracket. In my first interview of the day, I was asked whether debt or equity is more expensive, is a more expensive form of capital. He answered equity because it's less in the capital structure, therefore it's more risky, um, and also because cost of debt has an interest tax shield. And then the interviewer said, he followed up by asking if there were any situations in which equity would be less expensive than debt. I struggled a bit because I couldn't think of any because debt is always similar to equity. He took me back to CAPM and told me that if a firm had a negative beta, that could make its cost of equity lower than its cost of debt. Then in another interview with another analyst, I was asked pretty much the same exact question. Could cost of equity ever be less than the cost of debt? I said that it wouldn't typically be the case, but that it could be possible for a firm with a negative beta because CAPM, et cetera, et cetera. He looked at me incredulously and said, no, because debt is always similar to equity. Okay, that sucks. So both answers can be wrong. What's the right answer here? And then people said, that is always seen as equity's right answer. If there is a negative beta and the equity market risk premium is relatively high, then there would be a negative cost of equity, which is impossible. Yes, it's true that a company with a negative beta will have a low cost of equity, but debt will always be lower. It has to be because there's always less risk with debt. The first guy asked you if it were possible to do a negative beta, or did he tell you this? What is the conclusion of this? Here's a rational investor is only concerned about the risk of his portfolio. Adding the negative beta stock reduces his portfolio risk. He will accept a lower return for the equity. Is the standalone risk of the equity greater than that of the debt? Yes, due to seniority. That is not the appropriate way to analyze investments. And if you don't believe me, take it from the king evaluation. What are the consequences of negative beta? The expected return on that investment will be less than the risk-free rate. Okay, and he's citing Damodaran, which is, isn't he a professor at NYU? He is, right?
True. I don't know.
If we assume CAPM is a valid model, the required return on equity for a negative beta stock could be negative. I would think about it this way. Essentially, you would be paying for insurance, a form of hedging. In that theoretical case, the cost of equity would be less than the cost of debt, simply because credit risk cannot be negative. Does that make sense, though, in the context of reality? I'm not positive. The reason assumption CAPM is possible.
Okay.
Yeah, I mean, there's this link, which I haven't had time to read, but I guess I'll drop this in the chat and you can take a look at this. This is Damodaran writing, can betas be negative?
Okay.
Yes, betas can be negative to see how and why. Consider what they measure, blah, blah, blah. What are the consequences of negative beta? The expected return on that investment will be less than the risk-free rate. The nominal returns on gold over the last 4 years has been 2% less on average annually than the risk-free rate. However, that makes complete sense if you think of it as bond insurance. Think of the insurance by setting a very low even every return. So I don't think you would get a negative cost of equity, but I guess it would be lower than the risk-free rate. So it's still positive, but just low. Not sure how that works with CAPM though. Yeah, I don't know. Sorry.
No. Okay. I didn't know if that wouldn't be on an interview most likely.
Yeah. I mean, there's some comments here on the article about CAPM too. So I don't know. I think we just have to take some time to read through this, but we don't have to do that right now. I doubt they will ask you that. I don't know. I've never heard that question before. It's risk-free rate plus, oh, actually, CAPM is risk-free rate plus beta times the market risk premium, right? That's what it is. So it's risk-free rate plus beta times the market risk premium. So if your beta is negative, then I guess that means that it's going to be the risk-free rate minus whatever that second part of the equation is, which is why your cost of equity would then be lower than the risk-free rate.
But by order of operations, don't you? I thought it was you multiply levered beta by risk.
So you multiply beta by the market risk premium first.
Yeah.
You get a number. And you
Which would be negative.
Which will be negative. Yeah, and then so that number is getting subtracted from the risk-free rate, right?
Right.
So.
But isn't the stock market return normally 5 to 10%? So it's always going to be greater than the risk-free rate if it was multiplied by levered beta.
I guess it depends on what the beta is. But it looks like a lot of people in the comments are saying that if it's a negative number, then the CAPM doesn't work.
Yeah.
Which is probably exactly for the exact same reasons why we're saying, because you're not going to have like negative cost of equity. Like negative cost of equity would mean that the investor who's giving you money in exchange for your equity, they're like expecting a negative return for giving you money, right? Just no one would ever do that.
Right.
Right? It's almost like your investors paying you to take their money, which doesn't make sense. Right?
Because beta is about volatility, right? Not about returns. That's why a negative wouldn't, right?
Yeah, I mean, beta is supposed to measure volatility, yeah. Yeah, I mean, there's also comments down here like, it's hard to find a true negative beta stock because for any good, for any like even insurance type goods like gold or guns or ammunition, doomsday prep stuff, like stuff that's supposed to go up when the stock market's going down, there's a chunk of the population more willing to buy the good when times are good, i.e. some guy who goes out and spends a Christmas bonus on gold/guns. This is what makes finding a non-financial/derivative negative beta stock so hard. Yeah, so this is just saying like it's very, very hard to find like I think an entire industry where all the companies and all the comps in there have negative beta. So it's kind of what we said earlier.
Okay.
It's a good question, though.
Okay. Okay. So that was that. And then this was just a really quick random question. I was just looking at a deal. Canadian Pacific acquired Kansas City Southern, which is huge. They were talking about the voting trust, which was kind of the ultimate part that made Kansas KCS go with Canadian Pacific over Canadian National. But what is a voting trust at the end? I didn't understand that with like shareholders, that they give like the rights to a trustee that enables.
Yeah.
I didn't understand like what a voting trust was.
A voting trust?
Yeah. Like when a merger is happening or an acquisition, like before it, like I guess it gets the green light or something. You have a voting trust.
I don't know.
Okay.
I never dealt with this, but I just looked it up and it says a voting trust is a legal trust created to combine the voting power of shareholders by temporarily transferring their shares to the trustee. In exchange for those shares, shareholders receive certificates indicating they are beneficiaries of the trust. The trustee is often obligated to vote in accord with the wishes of these participating shareholders. So Basically, a voting trust is a contract between shareholders in which their shares and voting rights are temporarily transferred to a trustee. Shareholders agree to vote a certain way on specific issues without giving their shares or voting rights. Voting trusts are formed for many reasons, including preventing hostile takeovers, retaining majority control, and resolving conflicts of interest. Voting trusts are often formed by company directors, but sometimes a group of shareholders will form one to exercise some control over the corporation. It can also be used to resolve conflicts of interest, increase shareholders' voting power, or ward off a hostile takeover. The trust agreement typically specifies that the beneficiaries will continue to receive dividend payments and any other distributions from the corporation. The laws governing the duration of a trust differ from state to state. So it sounds like this is just like shareholders kind of like putting their votes together so that they have more influence when they're voting on issues.
Okay, but it's not a typical part of the process. It's not.
I don't think it. I don't think it's a common thing that happens in deals. That's what you're asking. And I also like. I think if you're not familiar with it and you're not really sure how it works, like I just wouldn't bring it up in the interview.
Okay. Yeah, that makes sense.
Yeah.
Okay. Yeah. Yeah. Okay. Those were the questions for the general trend. Maybe, okay. Maybe could we do some technicals or just yeah, concepts?
Okay.
Do that more.
Is there a specific area that you feel like you need the most practice with?
If we could do, no, not real. I mean, overall, anything maybe.
Okay. Let me see here. Let's say, what should I ask you? Okay. Let's do, okay. Let's say the buyer has a PE multiple, it's 10x, and the seller has a PE multiple that's 12x. And let's say the buyer's interest rate on cash is 2%, and the interest rate on debt is 8%. And let's say the buyer is paying for this deal with a mix of 30% cash, 20% debt, 50% equity, and let's pretend the tax rate is 40%. So what's like a kind of a quick back of the envelope way to calculate whether this deal is accretive or dilutive?
So one thing you can do is look at the reciprocal of the buyer's P multiple and the seller's P multiple. So if it's 10x for the buyer, that would be 1/10, which is greater than the reciprocal of the seller's. So if the buyer's P multiple is greater than the seller's, then it's an accretive deal. But that's if it's an all stock deal, right? That's if it's an all stock deal. So because it's not an all stock deal, we would do, so the cost of cash is 3 times the 3% times 30%, which would be.
Sorry, cost of cash is how much?
You said it's 3%.
2%.
Or 2% times 30%.
Is that it though? Is this 2% times 30%? What are you missing?
Oh, so okay. So cash is 2%, debt is 8%, and equity is 50%, you said? right? Wait.
Right. 30% cash, 20% debt, 50% equity.
Oh, okay. So, and then cash is, because it's interest income, it's tax deductible. So it's 30% times, you said the tax was
40%.
40%. So it would be that times y minus 40%, which is 60%, right?
Okay.
So cost of cash would be, so it's 2% times 30%. And then so that's 0.6% times 60% would be 1.2% would be the cost of cash. And then cost of debt would be,
you did 2% times 30% is 0.6.
Mm-hmm.
And 0.6 times 0.6 is how much?
0.6 times 0.6 is 0.36.
Okay.
Okay.
So 0.36
and then you do the cost of debt, which is the same. So it's 8% times 8% times 20% times 8% times 20% times the 60% for the tax. So that would give you, so 8% times 20% would be 1.6%. Yeah, 1.6% times 60% would be 9 points. Wait.
So okay. I think an easier way to do the mental math.
Yeah.
Right now you're multiplying like the 30% like with like the cost of capital like before it's been tax affected. I think you should tax affect the cost of capital first and then apply the weighting. So for example, if cost of debt is 8%, and then you know the tax yield is 40%. That means that 8% times 60% is 4.8%, right? Because you could just do 8 times 6,
okay.
48.
Yeah.
And you move the decimal, so it's 4.8. And then from there, if you do 4.8 times the weighting, that's 4.8 times 20%, right? It's easy to multiply something by 20% because you just multiply by 10% and then double it.
Mm-hmm. Yeah.
Right? So 4.8 times 20% would be, 0.48 times 2, which is 0.96%. Right?
Mm-hmm.
Does that make sense?
Yep.
And like even for the previous one, for cost of cash, the same thing. You did it in this order, but I would have done 2% times 0.6 is 1.2%. Right? Then 1.2%, if you have to weight that by 30%, then that means it's 0.12% times 3. Right? Okay. You multiply by 10% first, and then you multiply by 3. Right? Okay. So that's how you get to the 0.36.
Yeah. Yeah.
Yeah.
You said 1.36?
No, 0.36.
Yeah, okay. Okay. So that, and then for equity, it would be the reciprocal. So P multiple is 12x. Wait, equity was, so it'd be 1/12, right?
Or should we be using the P multiple of the buyer or the seller?
The buyer.
Right, and the buyer's P is what?
Is 1/10.
Right. So.
Right. So 10%.
Okay.
Times 50% is 5%.
Okay. So the total is.
So it's 5% and then 0.36%. And then we said that, I think, okay, 8% times the 20% was, 8% times the 60% was 4.8% times the 2% was 9.6%. That's way too high.
No, are you doing the cost of cost of debt portion weighted for 20% is 0.96%, right? We already did that, right? 4.8 times 20% is 0.96%.
Yeah.
So 0.96% plus 0.36 is 1.32.
So it's 6.32.
Yeah, so 6.32.
6.32. So that's the cost of the deal. And the seller is 1/12, which is like what they're giving in revenue. 1/12.
Yeah, well, so, right, 1/12, exactly.
Which is like 8%.
Yeah, a little over 8%.
So that's
8.3.
Greater than 6.32. So it would be an accretive deal.
So it's accretive or dilutive, you said?
Wait, so I know, so seller's income plus the synergies have to be greater than the cost of the deal. But so what we calculated was the cost of the deal and but what we calculated was the cost of the deal, and then 8% is greater than the 6%, so it's an accretive deal.
Yeah, it's accretive. Yeah. Yeah. Okay. Yeah, it's accretive. So we got it.
Okay.
So that's the right answer, but I think it can just be a little bit smoother, right?
Yeah.
Does that make sense?
Yeah. Yeah. I think it's just the mental math. Especially the mental math. There's like easy ways around it. Like I was going through the session that you went through that we did a couple weeks ago, and I think it was like, I don't know, 50% times 10%. For some reason I couldn't get that. So just like overthinking the really silly things.
Yeah, I think just like I said, do the tax effect first and then do the weighting, and it'll be a lot easier.
Okay.
Cool.
Yep.
Okay. Let's see. Let's do one more. So let's say there's a PE firm and they buy a company for the same amount that they sell it for 5 years later. So like, let's say they buy the company for $100 and then they sell the company 5 years later for $100. Okay. Is it possible for that deal to like hit the typical return requirements for a private equity firm? And what is the typical returns that they want to see?
Like 20 to 25%.
20-25%. Okay. So if they bought it for $100 and they sell it for $100 in 5 years, do you think it's possible for them to hit 20-25%?
No.
No? Why?
Because the 20-25%, they would have to, you calculate it with the multiple of invested capital, which would have to grow. And then you said they would sell it in 5 years.
Yeah, if they sell it in 5 years.
Right. So, I mean, they would have to have a MOIC or a multiple on invested capital, and then that to 1/5 would have to be 20 to 25, and that's impossible if they sell it at 100 for them to get those returns.
Well,
right.
I mean, let's think about this, right? So
100, and they sell it at 100.
Yeah. That's the overall enterprise value, though. give you a hint.
Okay. Oh, okay. Well, couldn't that be like, okay, so like EBITDA could have grown, but they're selling at a smaller multiple, right?
I mean,
Because if EBITDA,
that could be a reason why it sells for the same price, sure, but what that doesn't really answer the question of whether it's possible for them to generate 20% IRR though. Or like,
no.
so
Well,
like
I
for
would say,
example, so for example, I'll put it this way: 25% IRR. If we want to hit 25% IRR in 5 years, we said,
mm-hmm.
and that means that you need to roughly triple your money.
Mm-hmm.
So we know they're buying when they bought the company was worth 100. When they sold it was also worth 100.
Yeah.
So obviously the value of the company didn't go up by 3x.
Right.
But is there another way for the PE firm? Or the PE firm could have gotten 3x return on their money? What do PE firms do when they buy a company?
They buy it with debt and equity.
Buy with debt and equity. Okay.
Right.
So.
Oh, okay. Okay. Wait. Okay. So, well, yeah, right? It could be like, I mean, the returns are based off of their equity, right? Not of the whole enterprise value, right? How much they grew the equity that they put into the company. So if they put like a smaller amount of equity and exited with a smaller amount of equity, they just didn't pay down all the debt. I think I'm just thinking, right? If they just grew the equity.
It's through debt pay down, right?
Right.
Basically, if they bought the company, say hypothetically for $20 of their own equity, $80 of debt, that's the $100, right?
Yeah.
Then during these 5 years, the company generates free cash flow each year, which is then used to pay down some of the $80 debt. Such that, let's say we pay off half of it during the 5 years. Now we paid off $40 out of the 80. So then like 5 years from now, when they sell the company and it's still worth $100, there's only $40 of debt left instead of the initial 80.
Yeah.
So now the equity is worth 60. They only put in 20. 60 over 20 is 25%.
Yeah.
Right?
Right.
So the answer is yes, it's possible.
Mm-hmm.
Right?
Right.
Yeah.
If I was asked something like this, like, is it okay to go through the logic of it, or is it best to use numbers?
What do you mean go through the logic of it?
Like kind of just talk about that. Like if you have a certain amount of equity and during those 5 years, you triple it, but you don't fully pay down the debt and you just triple the amount of equity you have, you could still have an IRR.
You don't know the exact numbers, but I think you can just say, yeah, like basically you like most PE firms try to at least double or triple their IRR, or sorry, double or triple the amount of equity they put in within the first 5 years. So like one way you could do that, even if the overall value of the company doesn't increase, is by paying down the debt. So you can just say that.
Okay. If
you pay down enough debt, the portion of the company that you own could increase by more than 2 to 3x, right? Starting out, people only own 20% of the company because they paid $20 of the equity and then the rest was borrowed money.
Okay.
Once you pay down enough of the borrowed money, that all becomes equity. That becomes just like ownership for the PE firm, right?
Yeah.
Does that make sense?
Yeah.
Okay. So we do a similar but slightly different one. So say there's a PE firm that buys a company for the same multiple that it sells it for 5 years later. So let's say like it bought for, 10 times EBITDA, and it also sells it for 10 times EBITDA 5 years later. And let's say they don't pay down any debt during the 5 years. Is it still possible for them to hit the required returns?
They don't pay down any debt.
No.
No, because I mean your profit, the profits that you generate are basically from the debt that you're trying to pay down. Like by definition, isn't like if you're okay, you go in with a times 10 and you exit with a times like I'm thinking the only variables you can control are the price, the EBIT, the amount of equity you put in.
So again, what
and
we
like
say here is it's the same entry multiple, and the entry multiple is the same as the exit multiple.
yeah. Oh yeah, but we're not talking about the amount of equity that they put.
Yeah, we didn't say anything about how much equity they put in. We just said they buy it and sell it for the same multiple, but they don't pay down any debt during the 5 years.
Well, I mean, so the returns that they get are from paying down debt, right? Because you're trying every time, like by the end of the year, your IR is based on you having, it doesn't have to be more equity than what you started with, right? A greater percentage of equity than debt.
So this is kind of a trick question. Like you don't really know, you don't really have enough information because like if they told you it's the same multiple, but typically like if even a company has the exact same multiple 5 years later, typically the value of the company will have gone up because EBITDA presumably would have grown during the last 5 years. As long as the company shit, like the company is growing at all, like their profitability hopefully is going up. So like say like initially if their EBITDA was $100 and they got bought for 10x EBITDA, that means their enterprise value was $1,000, right? But let's say like 5 years from now, their EBITDA has doubled from $100 to $200. Then even though they're selling it for also 10x EBITDA, now the 10x EBITDA is $2,000. So that means that they bought for $1,000 and they sold for $2,000, right? And depending on how much debt there is, because none of the debt was paid off, you can calculate like whether your equity portion of the deal went up by enough, right? But if let's say if like the EBITDA started at $100 and then it only grew to, or it didn't grow at all, it stayed at $100, that would mean that you bought it for $1,000 and you sold it for $1,000. That amount is the same.
Okay.
So then like the IRR would be zero, right? Because there's does that make sense?
Yep.
I think both of these questions I asked you, it's like it's basically like just a different way of asking like what are the drivers of increasing your returns in the LBO, right? We talked about like, I think we talked about this before, but it's like the price you pay. So like entry versus exit multiples, that's like one way to generate return. If your exit multiple is higher than your entry, everything else stays the same, you're still gonna make money, right? Second thing is like how much debt are you using, right? So like the more debt you use, the higher your returns typically, but also like, going back to the last question is like debt pay down. If you can pay down more debt, it's gonna create more equity, right? And the third and final driver is like if you grow the business and just make the business more valuable, which is kind of like this last question, like if the EBITDA is going up, then you're still generating a return, even if you hold the other variables constant. Because all it's saying is like, let's hold the purchase price constant, which is that first driver. Let's like not pay down any debt. So like there's no return being generated from like reducing the debt. And then so like the only other variable then is like, are we growing the EBITDA, right? Those are like the two drivers. Does that make sense?
Yeah. But
so like
it's really hard.
Yes, because of the value of the company is like the enterprise value of a company is like EBITDA times EBITDA multiple.
Yep.
And then there's a debt component So when you subtract out the debt from the enterprise value, you get down to equity value. Right?
Yeah.
So then
Yeah.
if you think about that formula, like the levers are increase the EBITDA multiple or increase the EBITDA. Either of those two things will increase your overall enterprise value. And then the other variable is how much debt is there, because that'll affect like what equity value you back into, right?
Yeah.
Does that make sense?
Yep.
Were you going to say something?
No, I was following you. Yeah, that makes sense.
Okay.
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 Does that help?
Yeah, definitely. Yeah.
Cool. Any other questions?
No, I think that's good. No, that's pretty good.
Okay. Keep me posted on how the interview goes tomorrow. I feel like most, and this is for diversity, right? Yeah, I don't know. I feel like in my experience,
What I realized that I had thought when I told you about it, I told you I just submitted my like resume, but I was going back through all the notes, and this one like I had done a higher view, and I remember they had like asked me like market trends. It was like a difficult higher view. It was like a weird higher view. It was similar to the one with GS. So I did. It wasn't just like a random entry all, which is why I think they gave us the following interview. But I don't know what you were gonna say.
oh, sorry, your volume just went way up all of a sudden, so it threw me off. But I was gonna say like if this is a diversity interview, like I don't know. Typically, I find that diversity interviews they don't get like as technical, and so I don't know. I feel like you know your technicals. You know, you just kind of like sometimes you have to like kind of work your way through it.
Yeah.
But I feel like you know the concepts, and like when I explain it, you understand it too. So I think it's just gonna come down to execution. You know, just like not messing up on stuff that you actually already. So
Yeah, that makes sense. No, I've done a million more accounting questions definitely since like the last 2 weeks ago. And I don't know, I had completely forgot about the IB Vine and the other things that you had told me about. So I went back and started doing exercise. You always say you organize them by like in order from, can you hear me?
I can't. You were lagging a little bit, but yeah, what were you saying?
Okay. You always organize them in order. Normally, I guess that's such a broad question, but is it normally harder questions you say are like LBOs? But what about LBOs? It's like what you're asking me, is that level like basic of what you should know about an LBO, or is that more of the thinking process?
No, I think the questions that I just asked you are probably like, I wouldn't say those are like basic LBO questions. Those are probably like, I would say on the more advanced side. It's not that the concepts are hard, but it's the way that the question is asked.
Okay.
It requires you to really like think differently and think about these, like kind of apply these concepts, right? So yeah, no, I wouldn't say those are like easy by any means.
Okay.
Yeah, I feel like our connection is starting to get a little bit wobbly. I don't know why, but yeah, anyway, I mean, like your interview's tomorrow, so like I wouldn't like stress about it too much. Like you are where you are at, and I think like the most important thing at this point, I know it's like past midnight over there. The most important thing at this point is just like get a good night's rest. Make sure you're like, you know, on your A game and alert tomorrow, and then just execute, like I said, right? Like I don't think too much is gonna change between now and whenever your interview is tomorrow. So like the point of this is not to like for you to go back now and pull like an all-nighter or do a bunch of last minute cramming or whatever. Like definitely wouldn't do that. Okay.
Okay. Thanks, Sam.
Have a good night.
Bye. You too.
Bye.
Thank you for tuning in. If you enjoy the content, please subscribe to our channel or podcast so that you can get notified of all of our future episodes as well. If you'd like to apply to work with us so that we can help you in a similar way, feel free to reach out to our team at www.wallstreetmastermind.com/apply. The street is abbreviated to ST, so it's wallstmastermind.com/apply. Talk soon.